One can argue that a lot of these model portfolios that worked over the last 10, 20, 30 years, whether it's the 60-40, risk parity, are no longer going to work in the future. So how should investors think about how to invest in a high inflation environment? How can they diversify their portfolio well?
Yeah, so I think it's important to contextualize that for the last 40 years, really going back to 1981, when interest rates were around 20%, you had a regime where stocks and bonds were inversely correlated, right? So as equities, anytime there was an economic downturn, the result would be the Federal Reserve and global central banks would come in and they would lower the cost of capital to ease financial conditions. What this did was it actually, when you lower interest rates, bonds and interest rates are inversely correlated, so the value of your bond portfolio goes up.
Hi, I'm Crypto Positive. If you like this video, please leave a comment and subscribe to the channel. It's very important to the channel and gives me motivation to make more videos about crypto for you. And now let's go to the video.
And as the cost of capital goes down, other assets respond positively, right? Money is cheaper. So anytime equities saw a downturn, bonds saw an uptick. So this risk parity, this is kind of coined by Ray Dalio, a billionaire hedge fund manager, one of the most successful ever, kind of made his career on this trade of stocks and bonds being inversely correlated. And so 2021 happens, the everything bubble, the sovereign debt bubble, global debt levels are higher than they've ever been before, and now this inflation seemingly came out of nowhere, right? So now we have a stock bond correlation crisis, where everyone floods to fixed income or is fully allocated to fixed income, and okay. There's no protection in sovereign bonds. So I think really what we're seeing now is it's a sovereign debt bubble unwind, and even if in nominal terms bonds appreciate again, what's happening is we've already seen the peak of bonds in real purchasing power terms, and I don't think really people fully comprehend the implications there of bonds as fixed income as an asset class, basically offering negative real yields going forward.
Yeah, and that's so important to negative real yield, right? And one of the things that shocked me is just the volatility of these bond yields and the movements there, and the Fed, how aggressively they're going around this hiking cycle. And so, Preston, what does that do for the real economy? If I am an entrepreneur or a business trying to plan and model out into the future, how are operators supposed to perform economic calculations and allocate resources effectively in this environment where the money is being manipulated so aggressively and so fast?
I think the simple answer is they just build risk premiums into the price of everything to try to offset that risk. But let's pause there. Let's talk about how, when you look at models and you talk about all your models are destroyed, branded by Michael, which is completely 100% accurate. All the models are destroyed because when you talk about at the crux and the keystone of economic calculation, it starts with inflation. And when you manipulate the cost of capital for 40 years, what's happening that's not discussed in the actual economy is what you're doing is you're destroying competition because you're stepping in and you're having market consolidation happen in the quote-unquote free and open market. And what that does is it removes the biodiversity of competition amongst vendors. So let me give you an example. Maybe you had 10 companies that used to supply part widget A, right? So over time, over 40 years of these types of activities, it goes to 7, it goes to 5, it goes to 3. And now one of those 3 vendors gets killed. Now you only have 2. Well, all your models for just-in-time supply chain management that were optimized for Lean Six Sigma or whatever operational metrics you want to use for these super hyper optimized low-cost ways to do business and connectivity amongst the world starts to break down. What happens is you don't have 1 or 2% inflation for the things that most people are accustomed to going out and buying, and it starts to creep in. And then that compounds. And then all of a sudden you're not dealing with 1 or 2% inflation in this basket of things that people were telling you to look at, you start seeing 5%, then you see 8%. And then it starts getting to the point where, my God, is it going to be 10 or 20% next year? And so that's how it arrives out of quote unquote nowhere, is because a lot of the financiers are talking about things, but they're not talking about what's actually happening at the grassroots and at the small business or mid-cap business level with respect to supply chains. So then when you're talking about economic calculation that's being constructed off of this idea of quote unquote inflation, and you're doing free cash flow, you're doing free cash flows on top of inflation and hurdle rates of inflation, you can see how all your models are destroyed at that point. And that's hard for a lot of people that don't have a degree in economics, maybe aren't actually an operator or managing a large company, to be able to see both sides of this and to see why the bond market, as James described in great detail, is completely unwinding itself. And I don't know that, people talk about the end game. Are we in the end game?
I would say
maybe we are.
We have stepped into the end game. And here's the problem, right? So what Preston's describing as this inflation that becomes entrenched, okay? So the Fed's model is broken. The Fed is supposed to try to keep full employment and manage inflation to keep it acceptable, right? So now you're in an environment where we have 130 some odd % debt to GDP in the United States, okay? The problem with that is that we're running at a deficit. We're running at right now a run rate of $1.1 trillion deficit in the United States. Okay, so that means that we have to issue $1 trillion, $1.1 trillion of bonds right now in order to meet that margin. Okay, but you're now issuing those bonds at an interest rate that's going up, right? So you're issuing bonds at an interest rate that's going up, which means you have to pay more interest, which means that your gap, your deficit is going to grow. That means that the next year you have to issue more bonds, right? So if you just look at where we are right now, I was speaking with my partner, Larry Lepard, before we came up here, and if you just pro forma out, which means that you just project out what it's going to look like next year, right now we're running $1.1 trillion of a deficit. If you add in $600 billion of tax revenue that we will not receive this year because of the one-time tax haven or tax benefit that we had in 2020 from all that money printing. Well, if you take that and know we have to print that, then or we have to issue debt for that, then you know that we have $400 billion more of interest expense this year, plus a cost of living adjustment on Social Security and mandate programs, okay, of $150 billion. I mean, you're talking about a gap now that's $2.2 trillion next year. So we have to issue another $2.2 trillion of debt just to meet that. This breaks the Fed's model. They cannot raise rates at the rate that they want to and keep them where they need to bring that inflation down. And so it's a feedback loop that they will just allow inflation to run hot in order to raise GDP nominally, get a larger tax base nominally, and be able to pay down that debt.
And when you're talking about it being recursive, going back to this idea of consolidation of enterprise. So as they step into the market to fill that gap by just printing it, they're then feeding that lack of biodiversity among the competition in your free and open market, which just compounds on itself. And so what I think is often not discussed is when you look at the Fed and their actions right now, and any central bank's actions right now, they're trying to suck the demand out of the system. But the thing that nobody's talking about is maybe on the supply side, they're destroying the supply side so fast that it's actually outpacing the demand suffocation that they're trying to do to slow down the economy. And if that's actually playing out, you're not going to see prices drop like they've seen for 40 years when they do these raising of rates, because this is a different scenario.
Пустой зал, ожидание вокзала. Стою и смотрю куда-то в сторону перрона.